Thank you. Now let's take a look at the bigger picture. Tony Drake is with us, Drake and Associates. I'm glad you're with us because last week was such a tough week for stocks, and it looks like we're breaking a 6-day losing streak, and everything's taking off here. I mean, I see Ford, UAL, Nvidia, Enphase, American Airlines leading the S&P 500. Every single sector's in the green. What do you think is happening here over the last half hour or so?
Yeah, certainly coming off a tough 5 or 6 days of trading, and this could just be a situation where it's oversold. What I'm really excited about, though, is to see it's pretty broad across the market. You know, for so long we were seeing just certain names or certain sectors that were running, so it's nice to see a broad market rally. Don't know that that means we're completely out of the woods yet. Certainly some things we're watching with the feds and some geopolitical concerns, but really nice to see people wanting to get back in after this 6-day slide.
Yeah, and look, the NASDAQ was basically at a 3-month low. And the question becomes, do people start to have an appetite for tech once again? I mean, there's no doubt that we saw Nvidia sell off, and that was sort of that rub your eyes moment when I saw it was at 974 not that long ago. And, you know, when you see it selling off and going, it's at 794 now.
Yeah, Nvidia is one we've all been watching. I mean, it was flying so high. I think the fact that it pulled back should not have surprised everybody. It was probably healthy for it long term, but technology is one of those sectors, definitely has some, attraction to it. I think there's some long-term opportunity there. You could talk a little bit about the pricing of it right now, but when you look at where it's projected to go, if these interest rates continue to stabilize, I think there could be some opportunities there.
Right, understood. The Fed seriously paused? I mean, seriously paused where almost we could get no cuts this year?
I think that's what economists, a lot of strategists were starting to see. I think at the earliest September, but there's that big possibility of nothing this year. Of course, we know last week Powell said that there's a lack of further progress, so that's really holding them back. When you look at that 2% target, he said it's likely to take longer than expected to get there. So I think we're really thinking about the real risks that the Feds are probably looking at, and that could mean that we won't have cuts until March at the earliest. Although I think for now, probably likely more towards the end of the year. They've got the economy where they want it, and now they're just focused on these inflation numbers. But the big question, Nicole, I think is, what's the bar here? What's the standard we're shooting for? And my sense is they need 2, maybe 3 consecutive months of inflation numbers that are consistent with that 2% target. If I'm right, and that's the bar, the earliest they can get there is September. I just don't see rate cuts before that, although I'm hopeful that we're going to continue to see inflation data lower in the next couple months, which will give the Feds that room to ease, and I think some of the signals they're looking for.
Yeah, I mentioned the NASDAQ earlier. About 3/4 of the NASDAQ 100 are 10% off or more off the 52-week highs. So maybe people are starting to say it was a frothy market. It's becoming, and some are 20%, right? 1/3 almost, about 20% off the highs. So maybe people are starting to have a little bit of an appetite, thinking that things are just better positioned now versus being overvalued. You have sectors, you could tell me about your thoughts on tech, but energy, financials, and materials are ones that you think may outperform. Is that right?
Yeah, I mean, I think when we think about the economy, and we'll jump into some of those sectors, I think, it could be in trouble next year if the Federal Reserve doesn't take action at some point on these interest rates. If you think about classic monetary policy mechanisms, they're broken, meaning that, any changes made by the Fed will now take longer to trickle down into the real economy. That's the problem with a lot of the data they're looking at, is it's so delayed. So I think the real buyers, U.S. consumers, their largest liability is typically their mortgage, which was pretty much secured by so many folks when those interest rates were low during COVID. And U.S. companies also refinanced a lot of their debt at that same time. So the impact of sustained higher rates might not be felt until down the line when they have to refinance some of those. So I think those refinance and the rates are going to be a huge key to what we're looking at. But a couple sectors, Nicole, we like the energy sector. Generally, they're supported by relatively high oil prices. We've been seeing that. The sector's exhibiting exhibiting some great high quality aspects given that relatively high interest coverage ratio. So companies are pretty well positioned to pay interest due on that outstanding debt and still have a strong level of earnings.
Right. So energy certainly. And it's interesting because energy, the pullback today, I mean, when I see it at 82, you say, whoa, when we had just recently seen it, we were talking about the path of least resistance being closer to 90. I don't think people expected it to come closer to 80. How about financials? We've already heard from a lot of them, but we'll hear more from the regionals and other related type, whether it's fintech or credit cards or things like that. Financials?
Yeah, some great earnings reports coming up that are going to give us a little bit clearer picture. But, some segments benefited from rising interest rates. And this is one of them which allowed banks to lend at higher rates and insurance companies to increase returns on their collected policyholder premiums. So the economy has really proven to be relatively strong in the face of one of the most aggressive tightening cycles in history. On the downside, we want to watch a little bit if it might be too soon to tell whether long and variable lags associated with this monetary policy can be ignored, which means the economy, not quite out in the woods. A lot of things we're watching yet. So significant tightening in a pipeline amidst the fallout from last year's banking issues. Financial profits could take a hit, so we want to keep our eyes on that. But I think there could definitely be some opportunity.
Yeah, and last but not least, materials. What kind of materials are you talking about? I mean, is it infrastructure like copper and steel, or building materials like cement and paint, or rare earth materials, which goes into chemical as well? But what are we talking about when you say materials?
I really like a lot of the infrastructure spending. Nicole, you and I have talked about this, it feels like for months now. A lot of that spending just still hasn't come to fruition. And when you look at this material sector, it's usually sensitive to fluctuations in the global economy. We feel like there's not a very high risk of a global recession. Also sensitive to U.S. dollars and inflationary pressures. And in a less severe recession, the sector's profitability might not take as large of a hit. So we see that additional spending, some good economic conditions for materials. Want to be careful, though. They can underperform during rate hike cycles. So again, coming back to the Fed, we got our eyes on the Fed to see really what is that bar, what's going to give them the comfort that they need to begin to cut these rates.
Yeah. Tony Drake, great to see you. Drake and Associates. Thank you, Tony.
Thank you.